Bloomberg, while the pandemic nearly wiped out equity buybacks over the summer, a reawakening in recent months bodes well for European investors starved of returns, after buybacks in the blue-chip Euro Stoxx 50 index slumped about 95% in the summer months compared to last year. October marked an increase from 2019, according to data compiled by Bloomberg. November's tally was down 17%, but still at comparable levels to the prior month. That, along with the gradual return of halted dividends, indicates an uptick in shareholder returns as the worst of the pandemic's impact eases. Companies were not completely averse to revisiting their buyback policies, though fewer in number than the firms with active dividend policy. Barclays Plake strategists led by Magesh Kumar Chandrasekaran and Emmanuel Kai wrote last month in a note on third-quarter European earnings. They highlighted that a much larger proportion of companies have reinstated buybacks in Q3, and while equities have started to price in an economic recovery on the back of progress in coronavirus vaccines, the strength of the buyback resurgence will be tested in the coming months, with the early part of the year tending to be the busiest. To find income amid the misery, J.P. Morgan Asset Management's Sam Witherow considers what a complete return to normal scenario would mean for each stock. The co-manager of J.P. Morgan's Global Dividend and Global Equity Income Funds says he looks for valuations that have been most distorted by COVID-19. He is overweight on Europe, where valuations don't reflect the dividend recovery outlook. He said in an interview, "We're all going to be ordering our favorite drinks at our favorite bars. Valuations don't reflect that." Sam Witherow, JPMAM portfolio manager. Industries that were previously deemed to be safe dividend payers have suffered because of the unique nature of the current crisis and its regulatory consequences. While banks and energy companies were dethroned early on amid an oil slump and central banks' directives to shore up capital, the fallout of upended consumer behavior is also becoming clearer. While European banks are unlikely to pay dividends before the second half of 2021, their excess capital holds the potential for upgrades on earnings per share from buybacks, restructuring or mergers and acquisitions. RBC Capital Markets LLC analysts wrote in a note last month, the derivatives market is even more pessimistic. Euro Stoxx 50 dividend futures expiring in December 2021 and 2022 both remain about 19% below analysts' dividend per share expectations. Despite the positive vaccine news flow, the futures trade below their June levels, while the index itself has risen about 9% in the second half. Dividend stripping, the practice of buying a stock before a payout has been declared and selling after it is decoupled, could offer investors an attractive equity replacement in 2021. Goldman Sachs Group Inc. strategists including Christian Mueller-Glissman wrote in a report on December 1, "We just have to retune our brains to go back to what life was like before COVID," J.P. Morgan's Witherow said. "Because that's the reality we're going to end up in for most industries." Copyright 2020 Bloomberg LP.